This is Bazaar Morning Call, broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Hello and welcome. Well, we kickstart a new year, 2024, wishing you and your families a very, very happy new year. 2023 was a very good year for the equity markets, but above all, wishing you good health in the coming year. Hey guys.
And happiness.
And happiness.
Right. Happy New Year to everyone. We're bright and early, all ready to kickstart 2024 with all of you.
Happy New Year, folks. Happy New Year to all our viewers. Wishing that this year is healthy, positive, and it's filled with all things good for everyone out there. You know what's the best thing about coming to office on New Year's Day?
Please tell us.
You get to see the morning sun. Otherwise, imagine waking up by afternoon and, missing the morning. I was taking some positivity in from that. May that rising New Year sun fill us with hope and joy.
Absolutely. And never confuse the order, right? It's health.
Yes.
And then wealth.
Absolutely.
Right? So wishing everyone health above everything for 2024. And obviously 2023 was a good year for equity markets, and hopefully we have a pretty good year as well.
Absolutely, which makes the start of this year even more special because we're literally starting off on a high.
Yes.
But they also say that, when you are right at the top, then you need to be a little more cautious because there's always that risk of a bit of a fall. And I think that's how we're starting the 1st of January with a stupendous rally, 20% up in the Indian equity market, a 24% rally on the S&P 500, 45% on the Nasdaq. So very quickly, let's just dial back and look at the cues that we have in today. Of course, we don't have too much company in the form of other trading equity markets around the world. Pretty much the entire world is shut down. But for us, just to dial back, on Friday, we had some profit taking in the US market as well. Not just in India. We saw that tinge of red on Friday on our screens here. And that pretty much played out in the Western markets. So we had just a minor dip coming in on the S&P, on the Dow, and on the Nasdaq. But then, hey, who's complaining given the kind of year that we've had? Just to talk about some of the other cues, not too much moved in the bond markets. In the US 10-year was very close to that 3.8% handle. Cues are very, very thin in any case ahead of the New Year break. And ditto for oil. The good news on oil is that it came down to about 77 on Brent. So at least the fear with which we were looking at the Suez situation in the middle of December, that's been receding, and that continued on Friday as well. Now, I just want to talk about, a little bit. By the way, the dollar index is also around those 5-month lows. The dollar has been pretty well behaved. I just want to put up a couple of points for the yearly setup. How are we starting 2024? And there we're literally starting on a fabulous Goldilocks scenario, which, also makes you a little wary. But what's the Goldilocks? Well, for the US market itself, the setup is of this Goldilocks, that you will get a soft landing in the US. That's the biggest narrative right now. What I'm talking about is market consensus, that you will get that soft landing in the US, no hard recession, no major growth scare. And in addition, you'll get rate cuts from the US, which is why the US market has been rallying the way it is in the last couple of weeks. In India, we're expecting, if not, big rate cuts, but at least some dovishness perhaps from the Reserve Bank, a little bit of a let up on the tight policies that we've had for the better part of 2023. The general elections are perhaps the biggest event back home to watch out for in the middle of the year. And even there, the expectation is that you'll get status quo. And therefore, the positivity continues, and we got a glimpse of that in the state elections. Finally, by the way, on Friday, we had the Finance Ministry economic report come out, and that's saying all the right things as well. According to that report, we will be exceeding our 6.5% growth target for FY24 quite comfortably. That's the exact word used in that report. So the setup is so positive. And then let's talk about the flows. And these numbers, and they've been telling us a story all through December. In the last week, rarely is it that we keep getting a 4-digit buy figure in the cash market from the FIIs. And that continued the entire week right up to Friday, with volumes also being positive. That took the net tally, the FPI tally for December, to the highest we saw in the calendar year, over 66,000 crore rupees of net inflow coming in. So that deluge, that tsunami of foreign money that we started seeing in December, will that continue into the new year? That's a big question. Given that everything is so positive, I always look out for the risks, and perhaps some of the ones that we can put on the table right now. Geopolitics for sure, oil prices and what happens there. But guys, as they say, the biggest risks are always the unknown ones. So if I could, I'd put a question mark as the third point there. Is there a risk that we are not accounting for right now? But hey, I don't want to be negative. It's the start of the year, so let's keep it positive.
Well, that's right. Surbhi, as you said, the money that's been flowing in, the kind of FI money that's been flowing, that's been very, very good, and it's been holding us in good stead as well. The bulls, though, they'll be hoping to get rid of this January jinx, so to call it. Because the last 5 Januaries well, we've ended in the red. And on an average, in fact, because a couple of them were a little bit harsher on the downside, the actual returns in the last 5 years is a negative 2.5%. And we know 11 out of those 17 Januaries that we've seen so far, well, it's actually been in the red. So the bulls will want to get rid of this January jinx, so to call it. How the FI is positioned, well, you don't like when they're positioned so much on the long side. The positioning itself is much lighter, so maybe the next 3 to 4 sessions, you'll get a build-up in terms of open interest as well. But for the time being, they're net long with close to around 84,000 of the contracts on the long side. The options data should come up for you. 22,000 call, well, that was fairly active, and that did see a mix of activity in Friday's trading session. And the 21,500 put as well. So just going by both those two numbers, I'm bringing in a near-term support at around 21,450. That's the level you should be looking at on the downside. And since the 22,000 call has so much of open interest, well, that becomes a bit of a resistance zone. The 20 DMA, well, it's far away for both the Nifty as well as the Nifty Bank. But if you want to take note of that number, in case the near-term supports a break, then those are the numbers that you're looking at. So let's see how we go from here. Yes, we have been in an uptrend. So shorting the market should not be coming to mind as well. The uptrend is very much intact. If you are a longer term investor, it's very clear. Keep your SIPs going, keep the money coming. In the near term, if you're a trader, well, it is still a little bit tricky out there. You'll have to trail your stop losses, and maybe you don't want to add too many long positions. Wait for the volumes to catch up, and then, in fact, maybe take a fresh call on the markets as well.
Well, we spoke to a lot of experts, right, through the course of last week, and we asked them the outlook for 2024, and they all said, well, we've had such a strong run. But, I want to just start this conversation on a positive note. Is it possible that markets can rally in 2024 after a strong showing in 2023? 2023, Nifty up 20%, mid-caps up 45%. So Hiren Ved, we were chatting with him of Alchemy on Editors Roundtable on Friday, and he said there are multiple instances when the markets have given successive years of very strong return. Go back to the period between 2003 to 2008, the mother of all bull runs, right? Even after a 74% return in 2006, in 2007, we had a 16% return and a 20% return in 2008. Moving forward between 2013 and 2017. Yes, there was one blip of, 2016 where things corrected a bit. The markets lost some ground. But look at, 13, 14, 15. We've had, after a strong showing in 14, even in 2015, we had a 25% rally. So is it possible? Yes, it's possible. History tells us that you can have multiple years of successive strong returns. Will it happen? Well, that's not a call that we're going to be making, not, forecasting the future, but just want to put that out there. The factors which are contributing, the Goldilocks scenario that, Surbhi was alluding to, sustained retail participation, the resurgence of FPI inflows, buoyant global markets, the US 10-year yield in 2023 had hit a high of more than 5%. Now we're below the 4% handle. Brent crude has logged its first annual decline since 2020 with a fall of close to about 20%. The key results in the key factors in January, if we have to break the January jinx that Nigel was talking about, one, the auto sales trickle in. Earnings season, that starts with TCS and Infosys on 11th of January. That's next Thursday. And then on Friday, we have HCL Tech and Wipro. So next week towards the end, it's going to be all about IT. And then this year, you're not going to have the annual full budget. You're going to have a vote in account because this is the budget prior to the election. That takes place on the 1st of February. And just one final point in terms of flows, Surbhi mentioned that 1,460 crore in terms of FI inflows. Despite a negative close on Friday, not that we lost too much, both the FIs and DIIs were buyers. So irrespective of what's happening on the index, right? You go close up, you close down, the flows are coming through.
I think for the bulls this year, the biggest challenge as they start off is going to be to avoid the fear of heights. Psychologically, like you said, when you've rallied so much, you end up becoming cautious, but you don't want to miss perhaps some better times that could lie ahead.
And the last 2 months, actually, the rally has been very steep. Sometimes you're talking about, double-digit returns in an entire year, you'll be happy. Yeah, you got it just, towards the end itself.
65% of the annual return of 2023 just came in November and December.
In the last 2 months.
But you have to make no mistake, if you're a longer-term investor, this is the India story. Just keep putting money. I'm personally doing that as well, keeping my SIPs going, trying to upscale them at times. So if you're a longer-term investor, no worries at all.
There's one
Keep the
more
money
risk.
coming.
This year, 2024, is going to be the election year. Forget India.
Yeah.
You
Yeah.
also have US. You also have European Union, which will be voting. There are nearly, 64 countries. Time magazine has reported 64 countries. 49% of the world population will be voting in 2024. So this is going to be the election year, the mother of all elections.
But I'm with Nigel on this one. Just see the way people are traveling around, spending, the way people want to upgrade their lives. The India story is well and truly intact. So on that positive note, let's kick it off with the equity call this morning, the 1st of January, 2024. Gautam Dugar of Motilal Oswal Financial Services says after the sharp rebound, the Nifty now trades at a 12-month forward PE of 19.6 times, near its long period average of 20.2x. However, it is at 15% discount to the September 2021 high. Further, the market capitalization to GDP ratio is at 124%. Gautam says calendar year 23 was marked by multi-year high interest rates, concerns about banking crisis in the US and Europe, and geopolitical uncertainties. But calendar year 24 is likely to bring some moderation on these issues, especially on the interest rate front. With global liquidity tightening nearing its end, a healthy domestic macro and micro environment, strong domestic and retail participation, and expected political continuity post-24 elections, all of this bodes well for policy momentum in India.
Let's get you some money market views then. B. Prasanna of ICICI Bank says the dollar continued its softening trend and traded near year-low levels. The rupee underperformed and was stuck in a range as RBI bought dollars to recoup its reserves. Seasonal flows in the next quarter, improved trade data, and softening dollar makes the outlook for rupee positive in the medium term. He expects the rupee to trade in a range of 82.95 to 83.35 against the dollar for this week.
On bonds, Prasanna says global yields remained in consolidation phase amidst thin year-end liquidity. In domestic markets, continuous supply and tight systemic liquidity kept bond prices under pressure. State government announced much higher borrowing for the last quarter, which is expected to neutralize positive momentum arising out of improvement in liquidity in the new year. He expects bonds to trade under pressure with bear steepening bias and the 10-year benchmark yield to trade in a range of 7.15 to 7.25%.
All right, well, we got a lot of stocks that we're going to be tracking for you. We get to that in just a bit in our special Top 10 segment. For the time being, though, we run you through the list. We're looking at Bandhan Bank, Yes Bank, Grasim, ACC, BHEL, GPT Infra, KPI Green, Finiotex Chemicals, as well as Dhampur Sugar. All of them will be reacting to positive news flow, while you have Bodal Chemicals that could be reacting to negative news flow.